Hey, what's up everyone? Welcome back to another video. And in this video I'm going to be explaining to you how multi-time frame analysis works. But before we get to the video, check the link in the description for the full course and get 50% off if you use the top link. So, to start, we have here a monthly candlestick, a bullish monthly candlestick. Then we have this same monthly candlestick broken down into weekly candlesticks right here. And then we have this same monthly candlesticks and weekly candlesticks broken down into daily candlesticks, which is a little bit unfinished, but this is the breakdown of the candlesticks. So as you can see here, all of these different candlesticks represent the same thing, even though they might look drastically different. Like for starters, we have here the monthly candlestick is just one big bullish move upwards, while the weekly candlestick has a little bit of a retracement here before going up back, one retracement. And the daily candlesticks now have multiple retracements before pushing up to this very same point above here, as you can see. And this is how multi-time frame analysis works. We start by looking at the bigger time frame, which is the monthly or sometimes the weekly, and then we drop down to a lower time frame to try and pick up or try and identify the retracements that are called the retracements, such as this one right here and this one right here. And you might be wondering, what do we do? No, you might be wondering, why do we identify these retracements? And that's because we enter trades on these retracements, but we do not enter them on these time frames. We drop down to the 4-hour time frame after we identified the direction of the market using these bigger time frames. We drop down to the 4-hour time frame, and then we try to enter trades on these very retracements. So we enter them, maybe, or even this, we enter them on these highs up here before the retracement to catch the move downwards. Get rid of this. We try to catch these, we either try to catch the move up, change this a bit, change to black, make it a bit, we either try to catch these moves upwards or the pullbacks coming down. To get a good risk to reward ratio. Because if we enter a trade somewhere, let's say we enter a trade at the end, let's say we enter a buy trade after this very candlestick here, this bullish candlestick, and we enter a buy here. Let's say we enter a buy somewhere along, for example, let's say we enter a buy here, and we have our stop loss right below the open of this candlestick, and we're aiming for just this high right here. Let's say this is our trade. But if we enter at this bullish candlestick, it will be a losing trade, because price retrace back all the way down to our stop loss and would have knocked us out of this trade before coming up back and going into profit. But let's say we took this very same trade, instead of at the end of this bullish candlestick, let's say we took it at the end of this retracement, right? Let's say we took it at the end of this retracement right down here. We entered a buy at the close of this bearish candlestick, and we put our stop loss below the candlestick, and we're aiming for the exact same spot. Now, not only did we go directly into profit with no drawdown, but we got a good risk to reward ratio as well, a 1-to-7 risk to reward ratio. See, all of this is why we use multi-time frame analysis. Let's go into the charts to get some real examples. Let's go to Euro USD. Go to the multi-time frame. On the multi-time frame, as you can see, ignoring this month, which is June, see this candlestick right here, and May. Before that, we had 4 straight bearish candlesticks from the starting of the year all the way down until April. 4 straight bearish candlesticks. But just looking at this multi-time frame alone, we're not really able to see any pullbacks or any retracements in order to get a trade anywhere around here. But now if we go to the daily time frame now, if we go to the daily time frame, we can see the price was just always coming down with multiple you can see price was always coming down starting from the beginning of the year, which is right here. From the beginning of the year, price was just always coming down, forming lower lows and lower highs with multiple retracements. As you can see, from January here, price came down, then pulled back for retracement right up here before dropping down again for another retracement right here, then dropping down again for a smaller retracement right here before dropping down again for another retracement, which looks like right here. You see, and if we were able to take advantage of these retracements right here, let's say we took advantage of this one, we could have put our stop loss just above the top here. We could put our stop loss right above here and put our take profit right at the end of the move, right before the next retracement. And this would have been a 1-to-9 risk to reward ratio. Let's say we didn't catch that move and we caught the next one. I'll put our stop loss right above the peak and our take profit right before the next retracement. This would have been a 1-to-4 risk to reward ratio. And let's say we didn't catch these two and we took the third one. So we entered here with our stop loss right above the peak and our take profit right before the next retracement. This would have been a 1-to-3.83 risk to reward ratio. So now you see, this is why we use multi-time frame analysis in order to take trades. We get better entries and better risk to reward ratios. Also, we get to see what price is actually doing, or what direction price is actually going in, instead of just looking at the smaller time frames and not really knowing what direction price is going. See? And let's say we're looking to get an entry somewhere around here, this point right here, and this was back in March. Let's say we get trying to get an entry up here. We switch from the bigger time frame, which is either the weekly, monthly, or daily time frame. Switch from those to the 4-hour time frame now. Switch to the 4-hour time frame. Then we look for an entry right at the retracement before the drop. So let's say we're looking for an entry somewhere along here, and we got one somewhere here. This could have also given us an even better risk to reward ratio than just looking at the daily time frame alone, because we'd have a smaller stop loss with this same take profit. But your take profit would be the take profit will be, yeah, we'll look for the take profit on the bigger time frames while looking for the entries on the smaller time frame, which is the 4-hour time frame. See, so now we have a 34 pip stop loss with a 806 pip take profit. So that brings us to the end of this video. Thanks for watching, and check out the next one.